Hello there, welcome to Finance Teacher. In this video, we will discuss a structured product called the accumulator. We'll discuss the structure, the mechanics and risks with examples. So let's get going. Now, what is an accumulator? It is a structured product where the investor has the right and the obligation to buy or accumulate an asset at a specified price from the issuer in a specified quantity per observation period, for example per day, for a specified number of days. There could be a gearing feature that increases the number of units of an underlying asset to be purchased if the underlying price goes below the strike price. There could be a knockout feature that terminates the product or a barrier level that temporarily stops accumulation if the underlying price moves above that particular level. Note that the investor has both the right and the obligation to buy the underlying at the specified price, which is the strike price, subject to other terms such as the KO feature. Note that the investor's profit is his selling price minus the strike price at which he has purchased the shares of the underlying asset into the number of units of the underlying asset, for example, the number of shares. The issuer's profit is the strike price minus the average cost of purchase, because the issuer is selling the underlying asset to the investor at the strike price. You subtract the average cost of purchase of the asset of the issuer from this strike price and multiply the difference by the number of units of the assets sold. Of course, the investor's accumulation price is the issuer's selling price, which is the strike price, and the number of assets units accumulated by the investor is equal to the number of assets units sold by the issuer. We will discuss only the profit and loss of the investor. You can easily calculate the issuer's profit if you know its average cost of purchase. Let's take the example of an equity accumulator. Reference share is XYZ. The observation period is 3 months, which is 90 days. The initial market price is $10. The purchase price or strike price is $9. The KO or the barrier level is $11. And the number of shares to be purchased every day by the investor is 1,000. And the settlement is done every 30 days, and there is a gearing of 2x. Let's understand these terms. The terms state that the investor agrees to buy 1,000 shares per day of XYZ Corporation over 90 days at $9 per share, which is the strike price. At the time of signing the contract, the market price of the share is $10. Now this makes sense because normally an investor would like to accumulate shares when there is a correction in the stock and they believe that the price is a good bargain. Obviously, if an accumulator gives you the right to buy shares of a good company at a 10% discount for 90 days, it's a very good deal. However, since all rewards come with commensurate risks, the accumulator has a catch. The investor remains committed to buy 1,000 shares every day for 90 days, even if the share price crashes below $9. In that case, the investor will be accumulating shares at a premium to the market price. He cannot say no because he is obliged to buy the shares. In a bad luck scenario, the investor may end up losing a lot of money and there is no downside protection for the investor. What about the issuer? Isn't the issuer taking a lot of risk? What if the share price remains at $9.95 for all the 90 days? The issuer would lose a lot of money because he would have to deliver 1,000 shares worth $9,950 to the investor each day. In return, he will receive only $9,000 per day from the investor. And what if the share price flies away to $10.5? The issuer will lose even more money. And to save the issuer from such a mishap, accumulators cap the issuer's loss by placing a knockout barrier, for example at $11. At or beyond this knockout barrier, the contract will get terminated. That is, if on any day the barrier level is touched, the accumulator will get knocked out. For example, if the share price touches $11 on day 20, the product will get terminated on day 20. The whole contract will be settled for 19 days and both parties will go home. Therefore, the issuer's loss will get limited. Alternatively, the terms of the accumulator may be such that if the barrier level is touched, there will be no accumulation on that particular day, but the product will not get knocked out. It will continue to live and the investor may get to accumulate more shares The price cools off to below 11, which is the barrier level. The periodicity of the settlement may vary. For example, the asset price may be observed daily and the asset may be delivered monthly. Based on the number of days the asset price remains below the KO barrier. Once the shares are delivered to the investor, he may sell it in the market. Also, there could be a super risky accumulator where the investor is obliged to accumulate 2 times the number of shares if the asset price drops below the strike price. This is called the step-up feature or the gearing feature. For example, a 2 times gearing accumulator may require the investor to buy 2,000 shares per day on which the share price is at or below $9, which is the strike price. Else, the investor must accumulate 1,000 shares per day, subject to the KO barrier condition. Let's look at the main terms in an accumulator. The main terms include the strike price at which the investor accumulates the shares, the observation period, which could be daily or weekly, the number of shares to be accumulated per observation period, the settlement frequency, which could be monthly, quarterly, etc., the knockout barrier beyond which the accumulation temporarily stops or the product gets terminated. Let's look at the suitability and the features of accumulators. It is obvious that the accumulator is suitable for an investor who is bullish on the underlying price. At the least, he expects the underlying price to remain above the strike price so that he can make a profit. Moreover, accumulators are for risk takers, not risk-averse investors, because the downside protection is not there and there could be significant losses. Let's discuss the derivative components of an accumulator. One way to look at it is that the investor enters into a series of forward contracts to buy the underlying at the strike price, whatever the spot price, subject of course to the KO barrier condition. Another way to look at it is that the accumulator has a series of long calls and short puts embedded. The sale of puts finances the purchase of calls. The investor is long a series of call options on the underlying asset that he is accumulating. The call options enable the investor to buy the underlying asset at the strike price if the price of the underlying is higher than the strike price. By selling puts, the investor gives the issuer the right to sell the shares to the investor at the strike price, even if the price of the underlying is below the strike price or at the strike price. Let's take 2 examples to understand all we have learned a bit more clearly. Let's first discuss an equity accumulator to understand the mechanics of accumulators. In this accumulator, the reference share is XYZ Limited. The observation period is 3 months or 90 days. The initial spot price is $22 when the contract was entered into. The strike price is $20, at which the investor will be buying the shares. The KO barrier is $25. Number of shares per daily observations is 20,000. The settlement is done every 30 days and there is a gearing of 1.5 times. The investor is obliged to accumulate 20,000 shares of XYZ Limited at $20, which is the strike price. The accumulator has a KO barrier at $25, which will terminate the accumulator contract. That is, if the underlying price touches $25 or moves above it on any day, the contract will get terminated and the settlement will be done till the previous day. For example, if the KO event takes place on day 20, the settlement will be done till day 19. The gearing is 1.5 times, which means that for each day the underlying price is above $20, the strike price, the investor will accumulate 20,000 shares. However, if the underlying price is at or below $20 on any day, the investor will accumulate 1.5 into 20,000, which is 30,000 shares on that particular day. Let's presume that this is a funded accumulator where the investor has to pay the full amount for the shares accumulated from time to time. Had it been an unfunded accumulator, the investor would have put a margin or a fraction of the amount for the shares instead of the full amount. Let's look at scenario 1, where XYZ share price remains below 25 for all the 90 days. That means the product never gets knocked out. And the share price is $22 at maturity. Let's presume that the investor sells all the shares he has accumulated at $22. Therefore, for the 90 days, the investor will accumulate 20,000 into 90, which is 1.8 million shares of XYZ. For this accumulation, the investor must pay 1.8 million into $20, which is the strike price, which is a total of $36 million. The investor can sell the shares at $22, making a profit of 1.8 million into $22 minus $20, which is $3.6 million. Basically, the share price closed at $22 minus $20 divided by $20, which is 10% above the strike price. And the investor gained 3.6 million on an investment of 36 million, which is 10%. Let's look at scenario 2. The XYZ share price is less than $25 till day 35. On day 36, the share price touches $25. This means that on day 36, the product will get knocked out. The contract will get terminated. And let's say that the XYZ share price is $25 at maturity and the investor is able to sell the shares at this rate, $25. In this scenario, the investor will accumulate 20,000 into 35, which is equal to 700,000 shares of XYZ Limited. The investor must pay 700,000 into $20, which is the strike price, which is equal to $14 million. The investor can sell the shares at $25, making a profit of 700,000 into $25 minus $20, which is $3.5 million. Basically, the share price closed 25 minus 20 divided by 20, which is 25% above the strike price. And the investor gained $3.5 million on an investment of $14 million, which is 25% on his investment. Let's look at scenario 3, which describes the maximum theoretical loss of this accumulator. Let's say the XYZ share price closed at or below $20, that is below the strike price, for all the 90 days. That means the gearing will be in play for all the 90 days. And the share price at maturity, let's presume that it is 0, which is actually practically not possible, but let's take this theoretical scenario to calculate the maximum theoretical loss. The investor will accumulate 1.5 into 20,000, which is 30,000 shares every day for 90 days, which comes to 2.7 million shares of XYZ. Note that this is the maximum number of shares that the investor can accumulate in this accumulator. The investor must pay 2.7 million into $20, which is the strike price, which is equal to $54 million for his purchases. And the investor will lose the entire $54 million because the share price is 0 at maturity. We'll now look at a currency accumulator with a barrier to stop accumulation, but without the knockout feature. Note that in a currency accumulator, you have a currency pair. If you buy a Euro-USD currency pair, you buy Euro by selling or paying in USD. Therefore, the profit and loss need to be calculated accordingly. In this currency accumulator, you have the Euro-USD currency pair and the initial exchange rate is 1.08. The strike price is 97% of the initial spot price, which is 1.0476. The barrier level is 103% of the initial spot price, which is 1.1124. The daily accumulation, if the spot is less than the barrier, is euro 1000, and the daily accumulation if the spot price is equal to or greater than the barrier level is 0. That is, the accumulation stops on that particular day. The settlement is monthly, the tenure is 180 days, number of accumulation days in a month is 20, which basically means for 6 months, the total of 120 days, the investor will accumulate euros. As evident, if the closing exchange rate on any observation day is at or above the barrier level, there will be no accumulation, else the investor must accumulate euro 1000 for that day. Also note that there is no gearing feature in this accumulator that increases the risk. Let's look at scenario 1. The exchange rate at maturity is 1.055. The days below the barrier is 120 out of 120. That is, the product never goes beyond the barrier. Therefore, there will be accumulation on all the 120 days of the accumulator. If the Euro-USD trades below 1.124 on all the days during the 180 days, the investor will accumulate euro 20 into 6, which is 120 days basically, into 1000 euros per day, a total of euro 120,000 by paying USD 1.0476, which is the strike price, into 120,000. That is, he'll pay a total of USD 125,712. Note that the euro 120,000 is the maximum possible that the investor can accumulate because there is no gearing in this accumulator. Suppose the exchange rate is above 1.0476 on maturity, let's say it is 1.055. The investor may sell the accumulated euro for USD 120,000 into 1.055, which is USD 126,600, thereby making a profit of USD 126,600 minus USD 125,712, the initial purchase price, which is equal to USD 888. Or you can look at it this way, the profit is USD 1.055 minus 1.0476 into 120,000, which is USD 888. The percentage profit in terms of the US dollar is USD 126,600 minus USD 125,712 divided by USD 125,712, which is the investment amount, which is equal to USD 888 divided by USD 125,712, which is 0.706%. This is the same as USD 120,000 into 1.055 minus 1.0476 divided by 1.0476, which is equal to USD 120,000 into the percentage appreciation of the euro with respect to the purchase price. This comes to 0.706%. As you know, the appreciation of the euro is 1.055 minus 1.0476 divided by 1.0476. Note that the denominator is the strike price, which is the purchase price. This comes to 0.706%. Therefore, the percentage gain in USD terms is equivalent to the percentage appreciation in the euro, because you are buying euros at 1.0476 and selling it for 1.055. The profit in euros can be calculated simply by dividing the USD profit by the existing spot rate, that is euro 888 divided by 1.055, which is the same as multiplying euro 888 into 1 divided by 1.055. As you may know, if the euro USD is X, USD euro is 1 by X based on reciprocity. For example, if the euro USD is 1.0476, the USD euro will be 1 divided by 1.0476, which is 0.95456. Therefore, you can consider the above term as the USD profit multiplied by the USD euro exchange rate on maturity. Now this comes to euro 842 approximately. In percentage terms, the gain is euro 842 divided by euro 120,000, which is the initial amount, which is 0.701%. Now, the depreciation of the USD is 1 divided by 1.055 minus 1 divided by 1.0476 divided by 1 divided by 1.0476. Simplifying this, we get 1.476 minus 1.055 into 1 divided by 1.055, which is basically the change in euro terms multiplied by the USD euro rate at maturity, which again comes to minus 0.701%. The percentage gain in the euro terms is equivalent to the percentage depreciation in the USD, because you are selling at 1 divided by 1.055. Note that the percentage appreciation of the euro is not exactly the same as the corresponding depreciation of the USD if we consider 3 decimal places. This is obviously true for all currency pair quote movements, although the difference is small for the small exchange rate movements. Let's look at scenario 2. In this scenario, the exchange rate on maturity date is 1.045, which is basically below the strike price. The days at or below the barrier level are 80 out of the 120 days. If the euro USD closes at or below the barrier level 1.124 for 80 days and at or above the barrier level for 40 days, the investor will accumulate 80 into euro 1000. That is, the accumulation will be done only for the 80 days. For the 40 days, there will be no accumulation. The investor will accumulate 80 into 1000, which is euro 80,000, by paying USD 1.0476 into 80,000, which is USD 83,808. Now the investor can sell the euro 80,000 at the prevailing spot rate at maturity. As the spot rate on maturity is 1.045, he will get USD 80,000 into 1.045, which is 83,600 US dollars. Hence the investor will lose USD 83,600 minus USD 83,808, which is USD 208. This is the same as USD 80,000 into 1.045 minus 1.0476, which is the strike price. So again comes to minus USD 208. In percentage terms, the loss is minus USD 208 divided by USD 83,808, which is minus 0.248%. This is equal to 80,000 into 1.045 minus 1.0476 divided by 1.0476, which is the same as USD 80,000 into the percentage depreciation of the euro. This is because the depreciation of the euro is 1.045 minus 1.0476 divided by 1.0476. Note that the denominator is the strike price or the purchase price. This comes to minus 0.248%. The percentage loss in USD terms is equivalent to the percentage depreciation in the euro, because you buy euro at 1.0476 and sell it for 1.045. In euro terms, the loss is minus euro 208 divided by 1.045, which is the spot rate at maturity, which comes to euro 199. In percentage terms, the loss is minus euro 199 divided by euro 80,000, which is minus 0.249%. This is because the appreciation of the US dollars is 1 divided by 1.045 minus 1 divided by 1.0476 divided by 1 divided by 1.0476. Simplifying above, we get 1.0476 minus 1.045 into 1 divided by 1.045. This is basically the change in euro terms multiplied by the USD euro exchange rate on maturity. This comes to 0.249%. The percentage loss in euro is equivalent to the percentage appreciation in the USD, because you are selling USD at 1 divided by 1.045 to get the end euro amounts for calculation. Let's look at scenario 3. This gives the maximum theoretical loss possible. The exchange rate on maturity is 0, and it presumes that the euro USD trades below the KO barrier on all the fixing dates. That is, if the euro USD trades below 1.1124 on all the fixing dates during the 180 days, the investor will accumulate euro 20 into 6, which is 120 days, into 1000, which is euro 120,000, by paying USD 1.0476 into 120,000, which is USD 125,712. If the exchange rate falls to 0, hypothetically, this is the maximum possible loss that the investor can incur. As we know, the euro 120,000 is the maximum possible that the investor can accumulate, because there is no gearing multiple. Euro 120,000 is the maximum possible loss, although it is almost impossible. Let's now discuss an accumulator with a gearing or a step-up feature. The terms are the same, but there is a gearing or step-up feature at or below 1.0476, the strike price. The gearing is 3 times. Let's say the exchange rate on maturity date is 1.035. Days the spot rate is below the barrier of 1.124 is 70 out of 120. That means on 50 days it is above the barrier, and there will be no accumulation on those days. Days the spot rate is below the strike price of 1.0476 is 30 out of 120, which is basically 30 out of the 70 days. The exchange rate on maturity is 1.035. Let's take this variation. Let's say that the currency accumulated has 3 times gearing, and if the exchange rate is at or below the strike price on a particular day during the term of the accumulator, the investor must purchase euro 3 into 1000, which is euro 3000 on that day, by paying 1.046 into $3,000, which is USD 3143 approximately. Let's say that the euro USD spot remains below the KO barrier of 1.124 for 70 days during the 180-day terms. Out of the 70 days, the spot exchange rate remains at or below the strike for 30 days, that it is at or below 1.0476 for 30 days. The exchange rate on maturity is 1.035. The investor will accumulate euros for only 70 days. Out of the 70 days, he will accumulate euro 3000 per day for 30 days on which the exchange rate is at or below the strike price. On the balance 70 minus 30, which is equal to 40 days, he will accumulate euro 1000 per day. Therefore, his total accumulation is going to be 30 into euro 3000 plus 40 into euro 1000, which is euro 130,000. To buy these euros, the investor will have to pay USD 130,000 into 1.0476, which is USD 136,188. If the investor sells all the accumulated euros at the maturity exchange rate of 1.035, he will get USD 130,000 into 1.035, which is USD 134,550. The investor's loss is equal to 134,550 minus USD 136,188, which is USD 1638. This can also be calculated as USD 130,000 into 1.035 minus 1.0476, which is equal to minus USD 1638. In percentage terms, the USD loss is minus USD 1638 divided by USD 136,188, which is equal to minus 1.203%. This is because the percentage depreciation in the euro is 1.035 minus 1.0476 divided by 1.0476, which is minus 1.203%. In euro terms, the loss is equal to minus 1638 divided by 1.035, which is equal to the USD loss multiplied by the USD euro exchange rate on maturity, which is equal to euro 1583. In percentage terms, the euro loss is minus euro 1583 divided by 130,000, which is equal to 1.217%. This is because the percentage appreciation in USD is 1 divided by 1.035 minus 1 divided by 1.0476 divided by 1 divided by 1.0476. Simplifying, this comes to 1.0476 minus 1.0350 into the USD euro exchange rate on maturity. This is basically the change in euro terms multiplied by the USD euro exchange rate on maturity, and this comes to 1.217%. Let's now discuss the risks involved in accumulators. Obviously, there is a risk of significant loss because there is no capital preservation feature. The gearing may magnify the losses. In unfunded accumulators, there could be margin calls. In unfunded accumulators, there could be magnification of losses. This is because of the margin payments. Increase in margin percentage may result in forcing the investor to unwind his position. And there could be breakage costs for premature termination. There is always an uncertainty about the selling price of the accumulated shares. The KO barrier limits the profit potential by either stopping the accumulation or terminating the contract. This ends our video on accumulators. Please like the video and subscribe to our channel to support us. If you have any questions or comments, please write in the comment section or email us at wiseatfinance@gmail.com.